16 times since 1962, the stock market has done the exact same thing. Fall around 20% in a midterm year, then rip 46% of the low in the following 12 months. 16 out of 16, 100% of the time. But this year, the drop that sets the whole thing up hasn't come so far. So, is it the best buying window in 4 years, or the year this historic pattern finally breaks? Since 1962, the US stock market has run through 16 midterm election cycles. And in all 16, the S&P 500 did the same thing. Now, I want to be precise about this claim. Because if you spent any time on Twitter, you've probably seen the headline version of this stat. People will tell you that midterm years are always up. That's close, but not entirely accurate. Midterm years finish green 87% of the time. That's solid, but that's not the story. The story is what happens after the market puts in its low. Because in each of those 16 cycles, the S&P bottomed somewhere in the midterm year. In 11 out of the 16 midterm years, we even had an ugly, stomach-turning low. But 12 months later, it was trading higher. Every time. 16 out of 16, without exception. When you hear a streak like that, your first instinct should be skepticism. Such a flawless track record over 60 years usually means someone cherry-picked a start date or measured something meaningless. So we should ask two questions. Why does this keep happening? Is there a mechanism, or is it just pure coincidence? And will this year be the same? Because if the pattern is reliable, it sounds like easy money, right? The problem is the price of admission. Because to get that 12-month rally, you first have to survive the drop that sets it up. And this will hurt, because the average decline in midterm years is 20.8% from peak to trough. That's not a wobble, that's a real correction. On average, the midterm year is the single weakest year of the entire 4-year presidential cycle. The returns of the S&P 500 land in the low digits, while the other 3 years average around 11%. So, on paper, it's the year you'd least want to own stocks. But if you sell now, you are missing what's coming next. And that's the best year in the cycle. From that midterm year low, the S&P has gone on to gain 46% on average by the following year's high. And that's not once or twice. Across 23 separate instances going back to 1934, every single one was positive. The weakest was still up almost 15%, the strongest 87%. When we compare the average performance of the S&P 500 in midterm years versus all the other years since 1931, this picture emerges. We have a clear market stagnation between a temporary high in April and until the midterm election. This is our accumulation phase. Because after these hard months, the market takes off. So we have a small predictable pain for a far bigger payoff. But this forces an obvious question. Markets price in known information almost instantly. So why would an anomaly this large and this consistent happen every single cycle without getting front-run out of existence? To understand why this happens, you have to look at how markets price risk. Because markets can price almost anything. Bad earnings, rate hikes, even a recession. Give them the data and they will set a number. What they can't stand is not knowing. And in the month before a midterm, there are a lot of uncertainties. Who takes Congress? What happens to taxes, to spending, and to regulation? We can clearly see this in the VIX, the volatility index. During summer and early fall, this uncertainty rises until it peaks in October, way higher than in non-midterm years. And faced with a risk they can't price, investors do what they always do. They sell first and ask questions after the vote. But look at what happens the moment the votes are counted. The fog lifts, the risk gets priced, and stocks starts to rise again. That rally typically even starts about a month prior to the vote. And here's the part that's counterintuitive. It barely matters who wins. But that relief alone doesn't get you 46%. There is a second engine, and it's structural. The 12 months after a midterm are the run-up to a presidential election. And no sitting administration wants a weak economy or a sliding market heading into its own re-election fight. This is when the current presidents historically try to stimulate the economy to secure their re-election. So you have a market that just cleared a major political hurdle, going immediately into a year that's characterized by pro-growth policy. Markets know this. They front-run it. It's why the year after the midterm has historically been the strongest of the entire 4-year cycle. So this isn't a coincidence or cherry-picked time frame. It's caused by two forces. The predictable expansion and contraction of risk, followed by a policy-driven tailwind. But unfortunately, that is exactly what makes the next part so uncomfortable. Because in 2026, one of these forces might not be showing up. But before we go there, if you like this kind of analysis and think that it helps your own investing, hit subscribe. I post up to 2 of these videos every week where I dig through the data instead of just the headlines. And now, back to the uncomfortable part. Because while the historical pattern is clear, logical, and backed up by over 6 decades of data, 2026 might just be about to break it. We are past the halfway mark of the midterm year, deep into the stretch where the 20% drawdown usually shows up. But it hasn't. Yes, we had a correction in March because of the start of the war in Iran. But since then, the S&P has been grinding higher, with Wall Street's year-end targets sitting up around 7,650 points. So at the moment, we are already sitting at double-digit gains. So what happened to the fear? There are 2 things that drowned it out. First, the earnings. The profits in the S&P have held up much better than almost anyone expected. The earnings estimates have been consistently revised to the upside. Right now, the S&P-wide average estimations is 32.8% higher than it was 12 months ago. And price follows earnings far more reliably than it follows any election calendar. The second thing, and this is the odd one, is that a real crisis stole the spotlight. The Iran war and the resulting closure of the Strait of Hormuz in March created a real crisis. And next to such a live geopolitical event, the midterm election stops feeling like a thing that matters. And that's the crack in the whole thesis. Because the pattern needs a dip to work. The 46% rally is measured from a low. So if the low never forms, there is nothing to rebound from. No discount, no dip, no free lunch. Now, there are 2 ways to read this, and they point in opposite directions. Maybe the dip is just late. September is historically the worst month of the year, and we haven't reached it yet. So the weakness could still be coming. Or maybe this is the cycle where the pattern finally breaks. Because the forces driving this market right now have nothing to do with the election at all. One of those is a buying opportunity, the other a trap. And to tell them apart, we need to get honest what actually moves stock prices. Because this is what most people on Twitter or YouTube won't tell you. The people who build these midterm stats will actually be the first to tell you that elections aren't what drives the market. RBC Wealth Management ran the history back to 1953, and their own conclusion is clear. Earnings, the Fed, and innovation set stock prices. Seasonality can act as a minor tailwind, but it's a terrible foundation for an investment thesis. And you can see it in their own numbers. If we split the history by who is in power, the spread is all over the map. A Democratic presidency with a divided Congress? Stocks average 70% a year. A Republican president with a Democratic House? Under 5%. The macroeconomic cycle matters infinitely more than which party is in control. So what does that make the midterm pattern that promises you free money? A tailwind, and a real one. A statistic of 16 out of 16 isn't nothing. But a tailwind is not a foundation. You don't buy a stock because it's October of a midterm year. You buy a business because it's a good business at a fair price. And if the calendar happens to hand you a discount, you take it. So if you aren't going to build an investment thesis on the midterm election, how exactly do you use this data to manage your portfolio? The answer starts with what not to do. You don't manage it by sitting in cash, waiting for a 20% drawdown that might not show up. 2026 so far is proof that the dip isn't guaranteed, and waiting for the pullback is exactly how people sit out entire bull markets. The move isn't to time the low, it's to be ready for it. And being ready looks like this. You build your watch list now, while it's quiet, while nothing is on sale, of the businesses you'd actually want to own. Look for high quality names with durable margins, real free cash flow, and a moat that survives a bad year. And you decide in advance the price you would pay for each one. Then, if September does what September usually does, you are not panic scrolling headlines and need to try to figure out what's cheap. You already know and just need to execute. That's exactly why I'm building the tools over at my website quantrinsic.com. The quant scoring, the interactive semiconductor map, and all the deep dives that I have here on this channel. Because seasonal weakness isn't a signal to buy the market. It's a window to buy the right businesses at a better price, if that window ever opens. But where should you put your money? Which sectors are the strongest after a midterm election? Well, once the election is over, the historical data shows that market leadership rotates. The defensive sectors like consumer staples and utilities that investors hide in during high volatility environments tend to underperform, while technology and cyclical sectors lead the post-election relief rally. These are the names that generally do well in risk-on periods. So instead of treating this midterm statistics as your investment thesis, treat it as your timing. That 20% dip, if it comes, is a gift. It's a chance to buy quality stocks cheaper. But it's not a reason to buy anything at all. Do the work now so that you are prepared and the weakness becomes an opportunity instead of a scare. But as always, that's just my opinion. Now, I would really like to hear from you. Which stocks do you already have on your watch list and which stocks should I analyze next? Let me know in the comments. And if you would like to dive a bit deeper into tech stocks and the semiconductor segment specifically, I have a full guide right here that shows you what to watch out for and which metrics are misleading. And of course, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.